When equity markets sell off, there's usually a very clear reason, such as a pandemic, but in some cases the cause isn't clear, and these are called flash crashes. And there's a nice example of that from 2010. So in this video, we're going to look at the 3 triggers behind the 2010 sell-off, and also learn some lessons along the way, which will help you avoid getting burnt when the next flash crash happens. So let's look at the 2010 flash crash in a bit more detail. This video is sponsored by Blinkist. Go to blinkist.com/pensioncraft to claim a week's free trial and 25% off premium membership. To begin, let's look at what happened to markets on the day of the flash crash. At the time, markets were very jittery, and that was due to news headlines about what was going on in Greece, which were protests about austerity as a result of the Eurozone debt crisis. It looked as if the Eurozone might split up, and the euro might cease to exist, and that could have spilt volatility into all markets globally. Looking at government bond yields in Europe between 2008 and 2010, usually bonds had very similar yields. Okay, German bonds tended to have a lower yield than Greece, but there wasn't a huge difference between different countries. However, in 2010, you can see that things started to look quite different. The yield on Greek government bonds started to rise very sharply, and then we saw other countries in Europe, such as Portugal and Ireland, have their yields increase as well. That's because people were pricing in the possibility of a breakup of the Eurozone. And if the sovereign debt of these countries was redenominated in their local currency, then they'd be worth a lot less potentially. So traders in New York woke up on May the 6th to see headlines about banks being set on fire in Greece and running battles with the police, which didn't do anything for the market's nerves. Initially, when markets opened, things were a bit jittery, markets fell slightly, but there was nothing unusual. But then at about 2 p.m, equity markets took a huge nosedive downwards. And you can see both of those major indices fell by about 8% over a very short period of time. They rebounded very quickly afterwards, but you can see there was huge volatility as markets gradually recovered. But you don't see the real carnage unless you look at individual stocks and exchange-traded funds. And this example is a Russell 1000 Growth Index fund, which has a ticker IWF, which literally fell almost to zero. So if you look at the x-axis of this graph, you'll see that it's just a 15-minute period leading up to 3 o'clock. And over the space of about a minute, you can see the share price of IWF fall from about $50 down to $0.0001. And it wasn't just about stock prices falling. Here you can see the stock price for Sotheby's rise from about $30 up to $100,000 over the space of a few seconds. And even very large companies, blue chips like IBM, fell very sharply. So here's IBM over that critical period just before 3 p.m, falling from $122 down to around $116. So for a large cap like IBM, a 5% fall over a few minutes is a really big deal. Now you might have thought it was a large investment bank or a hedge fund which triggered this big sell-off, but the actual person who was nominated as the criminal behind it was completely unexpected. And that was Navinder Sarao, who later became known as the Hound of Hounslow. Now you'll notice that the date on this story is from 2015, and that's because it took US authorities 5 years to work out what had happened. There were 22 charges against Sarao, carrying a maximum prison sentence of 380 years. And the investigations found that he'd made about $9 million trading E-minis during that sell-off, and between 2010 and 2014, he'd made about $40 million trading these futures contracts. As it turned out, Sarao pleaded guilty to just 2 of those charges, electronic fraud and spoofing, which we'll talk about in a moment. Now the sentence was passed in US courts because he'd been extradited to the US from the UK, and they didn't push for jail time because he'd already served time in the UK, and also he was diagnosed as autistic, and he hadn't splurged out on luxuries. In fact, he'd lost almost all of his money to fraudsters. But you might be wondering, how did this guy working in his parents' bedroom in Hounslow manage to generate millions of dollars of profits? An app I use all the time to research these videos, but also for my personal education, is Blinkist. Here you can see the homepage of the app So you can see the latest blinks, which have just been added to the huge library of books, or you can listen to these shortcast episodes, which are like podcasts, usually around 10 minutes in length, or look at the latest trending blinks, which are popular. Now you take your favorite books and add them to your library. Here are some of the books in my library, which I've added recently. And here's the book which I've just been discussing, which is Flash Crash by Liam Vaughan. Now it starts off with a summary, but these are the individual blinks. There are 6 of them which go through the book topic by topic, and you can learn a bit more about the author here. This is what the first blink of those 6 looks like, and you can either read it or by clicking here, I can hear it read out, which is incredibly useful when I'm out and about. For example, when I'm walking my dog, Teddy. Then there's usually a suggestion of related books which you'll find interesting, and that's pretty accurate. In this case, it's The Man Who Solved the Market by Gregory Zuckerman. So if you do want to learn more about the Hound of Hounslow or read the thousands of other books which are summarised on Blinkist, just go to blinkist.com/pensioncraft and you get a week's free trial and 25% off premium membership. Sirau's success depended on being able to push markets in any direction he wanted through a process called spoofing. To understand how spoofing works, you have to understand the difference between an investor, like you and I, and a market maker. The primary difference between those two actors in markets is what they can control. An investor controls when they trade. They don't control the prices at which they trade. Whereas a market maker controls the price at which they trade, but they always have to be willing to trade. That's because their job is to create liquidity in markets. If you want to trade a stock, whether you buy it or sell it, they have to provide a price for buys and sells. How does the market maker decide on a price? Well, it's primarily driven by supply and demand. So if there are more sellers than buyers, then the price will be lowered. And that's because the job of the market maker is not to end up with a pile of inventory. If the price is too low, they'll end up having to buy lots of stock. If the price is too high, lots of people will buy from them and they'll run out of inventory. So the goal of the market maker is to make money on the difference between their buying and selling price. It's not to collect lots of inventory. So given that market makers set the price based on the number of people who want to buy and sell, we can immediately see how we might manipulate their price which they set. So let's imagine that we want to buy a stock. Of course, we want to pay as little as possible. So what we do is we place lots of fake sell orders. And these are usually limit orders which won't be triggered until the price meets a certain level. And at the same time, we set a genuine buy order at a fairly low price. Now, if the market maker sees lots of sell orders, they'll probably lower their price. And if that's true, our buy order will now be filled at our low price. Now that we've got what we wanted, we can cancel our fake sell orders. Now, there's always a risk that our fake sell orders will actually get filled. So this doesn't always work. But Sirau actually used a program in order to generate the spoof trades and to edit them automatically so they had a low probability of being filled. As a direct result of this investigation, spoofing was made illegal in the United States. And since then, many market players have received fines for spoofing, including Navinder Sirau, who had a fine of almost $40 million. But there are also some big investment banks who've been fined for spoofing. So for example, recently JP Morgan was fined almost $1 billion for spoofing. It turned out that Navinder stopped trading on May the 6th at 2 p.m. US time, which was actually before markets really sold off a lot. So once the ball was rolling, why did prices move so much? Well, it's not just market makers which provide liquidity. It's also large institutional investors like pension funds and asset managers like BlackRock and Vanguard. Now, generally what they do is they place orders to be filled for a certain number of shares at a certain price. So in this kind of toy example which I've got here, you can see the ask prices which allow you to buy at a fixed price, and below me you can see the bids which will allow you to sell. So the high prices are at the top here and the low prices are at the bottom. Now the best price at which we can buy currently is $105, but notice we can only buy 10 shares at that price. But it turns out that we actually want to buy 30 shares. So what could we do? Well, we could buy 10 shares at 105 and then the remaining 20 shares we could buy at the higher price of 110. And after our trades, this is what the order book, as it's called, would look like. And the best ask price is now $110. So the simple act of trading, by taking away some of the liquidity that was offered, has now moved the market. But it hasn't moved it too much. Now let's look at the situation when markets are distressed. Our best buying price, the best ask price, is still $105, but now we can only buy 5 shares at that price, whereas previously we could buy 10. In other words, we have much less market depth. So now if we wanted to buy 30 shares, we'd rapidly use up the liquidity at 105, we'd also eat all of the liquidity at 110, and we'd only leave a little bit of liquidity at 115. And the best ask price is now $115, so it's moved up $10 instead of $5. And the market impact of our trading has been much greater. That's the hallmark of not having enough market depth. So the definition of market depth is that when you trade a large amount, it doesn't move the price of a share much. And that in turn is because there are lots of large open orders which are close to the mid price of the market. So when times are good and we've got normal market conditions, we'd expect to see an order book that looks like this. For starters, the best bid price and the best ask price are very close together, and both of them are very close to the mid price. Also notice that there are plenty of open orders which are close to that mid price, and that's why when we place a trade, we won't move the market much. In contrast, in a distressed market, when there isn't much market depth, notice that the best ask price and the best bid price are very far apart. Also notice that now there are very few open orders which are close to the mid price, either for the asks or for the bids. Now, one of the largest exchange traded funds in the world is SPY, which tracks the S&P 500. And here we can track the market depth of SPY throughout the day, almost minute by minute, on May the 6th, 2010. Now, initially the market depth was pretty good, both for buy orders in blue and sell orders in red. But notice what happens as we get close to 2 p.m. when the big sell-off happened. The price of SPY fell sharply, as we've already seen, but at the same time, the buy depth and the sell depth fell very dramatically. That in turn amplified any market moves, because if you trade in a market with very little market depth, that moves prices much more. So this tended to amplify the losses which were already in place, and it generated those crazy market moves that we saw earlier. And as a consequence of having very little market depth, trades were executed at irrational prices, which as we've seen were as low as 1 cent or as high as $100,000. Now these were a consequence of something called stub quotes. Remember that market makers can't choose when to trade. If somebody wants to trade, they have to offer a bid and ask price. So in order to fulfill their role, which is to provide liquidity, they had to provide a market, even after they'd already decided to withdraw from active trading. So the moral is, you shouldn't trade at any price during one of these market dislocations. You may end up with one of these stub quotes and trade at a crazy price. The third catalyst for the sell-off is high-frequency trading. Although it didn't receive blame in the SEC report, another report by IOSCO in 2011 thought that high-frequency trading was a contributing factor in the flash crash. So what are high-frequency traders, or algorithmic traders as they're also called? Well, they're usually hedge funds and they usually have huge resources. What characterizes them is that they use computer programs or algorithms to access markets very quickly and place thousands of trades very rapidly, much more rapidly than a human could, for example. There is no single strategy that characterizes high-frequency traders, but let's look at one trade which is quite popular with high-frequency traders. And this is an example of an arbitrage trade, where you're effectively buying the same thing with different wrapping. In this case, there are two financial assets which track the value of the S&P 500. The first one trades in Chicago on the Chicago Mercantile Exchange, and that's the E-mini S&P futures contract. So let's imagine the price of that is currently $4,487. The second thing which is linked to the value of the S&P is SPY. In fact, the price of SPY is 1/10 of the S&P index. So the price there is 447.26. So if we multiply that by 10, we'll get 4473, which is cheaper than the E-mini. Now I've simplified this. You actually have to consider something else, which is called the carry cost on the futures contract. But don't worry about that. We'll imagine that SPY is trading cheap. That means we'll buy it where it trades, which is on the New York Stock Exchange. At the same time, we'll sell the expensive version of the S&P, which is the E-mini contract, and we'll do that on CME in Chicago. Now, these mispricings, these slight differences in price for these two securities, will only last a matter of milliseconds before they come back into line. So that means our reaction time has to be very quick indeed. In fact, it has to be so fast that we have to consider how long it takes for light to travel from Chicago to New York. Now you can see the distance between the two cities is just over 1,000 kilometers, and it actually takes 3.8 milliseconds for light to travel from one to the other. So the fastest form of communication will be microwaves. It turns out that if we use fiber optic cable, the speed of light is actually quite slow in glass in the fiber optic cable. So the signal will take a few more milliseconds to get from New York to Chicago. So that's how fast these high frequency traders have to be in their reactions to market mispricing. One of the memorable quotes from the movie Margin Call was that there are 3 ways to make a living in this business: be first, be smarter, or cheat. So clearly the high frequency traders have gone for the be first option. And in order to compete with them, Sorrell had to go for the third option, which was to cheat with those spoof trades. Now, hedge funds are typically very secretive, so it actually took 3 physicists to publish a paper in 2013 where they figured out from publicly available information that hedge funds had created this microwave link between Chicago and New York. What they did was to monitor those E-mini contracts in Chicago and then look to see whether it created trades in New York and how long the lag was between the two. Notice how in 2010, which is at the bottom of this graph here, the lag was over 10 milliseconds. So that suggested they were using fiber optic cables to connect the two exchanges. But by the time we get to 2012, the lag time has reduced significantly. And if we mark on the light travel time between Chicago and New York, which is 4 milliseconds, you can see that we're not far above that speed of light lag. The third part of the puzzle was to look at microwave links which had been approved by the FCC between Chicago and New York. And sure enough, some of these microwave routes were being used to pipe information about trades. Another interesting finding from the paper was that every time the E-mini ticked up or down in price in Chicago, the trading in SPY, the S&P 500 tracking ETF in New York, would suddenly speed up by a factor of 30 times. That's the direct result of high-frequency traders putting on lots of trades to arbitrage the difference between the two. And that way they could make money very rapidly as the prices converge. So how many trades on SPY do you think came from high-frequency trading? Well, it turned out to be about 15% of all the trades. Now, the cost of all that infrastructure was pretty steep. It was about $500 million, and the authors estimate that that was also roughly equal to the profit they made from the lower latency. Now, of course, since then, they've carried on doing that trade, and presumably they're deeply into profit now. Plus, that's not the only arbitrage trade which you can do. You can do this with many other indices and financial products. And in case you think this is all just harmless fun, high-frequency trading actually comes with a cost to you. And the reason for that is something called execution shortfall. So say, for example, you own a fund with BlackRock or Vanguard. Those asset managers are continually having to trade the contents of their funds, and that's in order to match the index. And these high-frequency traders can often anticipate those trades because they know the positions of the very large players. And the result of that is an execution shortfall. Markets will move up or down in anticipation of purchases or sales by these large players. And in a paper called A Blessing or a Curse, the impact of high-frequency trading on institutional investors, the author, Lin Tong, actually worked out the dollar amount that it's costing you. Now, of course, the large institutional players know this is happening, but there's very little they can do about it. They can see that their trades are being anticipated and taken advantage of by these high-frequency traders. And although the execution shortfall looks small, so this axis here on the left is percentage points, and usually it's between 0.1% and around 0.25% for the smallest stocks, you can see that for the stocks which have the greatest high-frequency trader intensity, generally the execution shortfall is larger. But because these large institutional traders are trading so much every day and in such large quantities, the actual daily cost is on average around $10,000 a day. And who's ultimately paying that price? Well, it's you and me. So to recap, the backdrop for the flash crash was that people were spooked about the European sovereign debt crisis. So markets were already jittery going into May the 6th. Narinder Sarao pushed markets down up until 2 p.m. and he did that with his spoof trades that made market makers think prices should be lower. And then the final factor which made markets really sell off at 2 p.m. was a lack of market depth. Liquidity was withdrawn from markets as market participants were spooked by the huge price moves. Now when the next flash crash happens, you'll be ready. But it won't be triggered by these spoof trades, which are now illegal. However, there's still the problem with liquidity, which gets withdrawn when markets go into a state of distress. So it's probably best just to step back from the markets and ride it out, because usually with a flash crash, markets recover very quickly. Now remember, there is an offer that goes with this video with Blinkist, such that you get a week free and you get 25% off premium membership. Just go to blinkist.com/pensioncraft to learn more, and there'll be a link in the description. And as always, thank you for listening.